The 2026 U.S. debt wall. Why the OBBBA won't save your portfolio. The U.S. economy isn't landing. It's being foamed by a desperate Federal Reserve. As we close out 2025, the S&P 500 is sitting near record highs. But don't be fooled by the Santa rally. We are entering 2026 with a strategic mistake. A reliance on tariff rebate checks and OBBBA tax refunds to mask a labor market that just saw hiring freeze to a 20-year low. Who pays the price? The American consumer, who is already seeing retail prices jump 5% due to tariff pass-through. While the Fed signals one more rate cut for February, the bond market is screaming that inflation will stay sticky at 3%. I am releasing the 2026 U.S. debt wall map today because the K-shaped recovery is about to snap. Subscribe and click the link in the related video to see which sectors are the true zombies of the 2026 refinancing crisis. To understand 2026, we have to acknowledge the chaos of 2025. We survived Liberation Day and the longest government shutdown in U.S. history. Historically, when the U.S. experiences this much policy friction, the lag effect hits the economy 6 to 9 months later. We are now in that window. In 1974 and 2000, we saw similar policy crosswinds where the market ignored the cracks until the structural floor gave way. Today, the floor is the $3 trillion AI infrastructure spend, and the cracks are starting to show. The OBBBA and the Fed's trap. Let's look at the numbers. The One Big Beautiful Bill Act, OBBBA, is set to dump billions in stimulus into the first half of 2026. This is the sugar hit. However, core PCE inflation is projected to peak above 3% in Q1 because of immigration restrictions and tariff impacts. Jerome Powell, whose term expires in May 2026, is trying to find neutral, but he's trapped. If he cuts rates to save the slowing labor market, hiring only 23,000 people per month, he reignites the inflation fire. If he holds, the $500 billion AI capex bubble bursts. The 10-year Treasury is already rebounding toward 4.2% in anticipation of this sticky inflation trap. Commercial real estate and AI hyperscalers. The 2026 debt wall is real. We are looking at a $1.2 trillion refinancing hurdle for corporate America. The regional banks still choked by commercial real estate defaults, and the AI hyperscalers who have spent $500 billion on infrastructure that isn't yet generating a one-to-one revenue return. In 2026, animal spirits won't be enough to cover a 15% earnings growth requirement. If the earnings don't manifest by Q2, the rotation out of tech will be a stampede, not a stroll. The K-shaped breaking point. Wealthy households are buoyed by record asset prices, but the lower-income cohorts are seeing subprime auto delinquencies and credit card defaults hit 2008 levels. This is the double-sided trap. The OBBBA refunds will help the top 20%, but the 3% inflation floor will crush the bottom 60%. As the U.S. dollar enters a choppy 2026, your purchasing power is the ultimate casualty. High retention line. A bull market built on stimulus checks is just a countdown to a correction. This New Year's Eve, don't just celebrate the S&P's gains, audit your exposure. If you are 100% in tech, you are ignoring the most dangerous yield curve normalization in 40 years. Tomorrow the markets are closed, but the $1.2 trillion debt wall is getting closer. Watch for my 2026 survival guide dropping this Friday. Subscribe so you don't miss the link.